Deborah, let's first kick off. I want to exchange-traded funds, ETFs. I think a lot of people know them. We've also got exchange-traded notes, relatively new to South Africa. Exchange-traded Ps. A quick touch on terminology, broad stroke. I mean, an exchange-traded fund. Are we bringing them all into it, or are we slicing and dicing, particularly with the notes, which have got that little bit of counterparty risk?
Right. So I think it is important to differentiate the products. So an exchange-traded fund is a fund where the assets are held at a custodian, ring-fenced from other funds and investors.
Yeah.
As we move to asset classes that were difficult to do in a fund structure because the index wasn't diversified, many of the products are now structured as notes. So many people would call them certificates. And so what that means is they are basically unsecured debt. So you have counterparty exposure to whoever the bank or broker or issuer is of that product. Some of the products are even partnerships. So if you buy a partnership at the end of the year, you'll receive a Form K where you're supposed to identify who the underlying investors are. So most private banks aren't really inclined to use that type of product because they don't want to say who their clients are. Some of the products in the US, when it's a grantor trust, they actually call them ETVs, or exchange traded vehicles. Some of them will be structured as secured notes. So it's really important, though, to understand the structure of the product and equally what's inside of it.
And that's a good point. I mean, ETFs, certainly in South Africa, 10.5 years old, started in November 2011. Globally, a relatively new product. What, Canada, the first market, I think?
Exactly.
In 1990. ETFs were the initial. Now we're seeing the slightly more exotics coming through. Is that where the growth is coming to a degree?
Well, no, it is kind of interesting. So you heard the statistics, 2,747 products that are really ETFs. If you look, the top 100 products, the core original usually that go and buy underlying securities, beta building blocks, those account for about 63% of all the assets. So what you find is that there's newer thematic, newer alternatives. They're interesting, but what we find is about half of the products out there have assets below 50 million, and about 300 have assets below 10 million. So we do find that certain products are very popular, and others would be used more as thematic investing or smaller slices of someone's portfolio.
Yeah. So we're seeing incredible flows coming through. We're seeing more and more products being listed on a monthly basis at this point in time. Last year, we had a lot of detractors saying that there is a lot of concern as to where the ETF market is headed globally, and perhaps it's starting to create a bit of a bubble. Would you concur with that? Can ETFs create a bubble, or do you think they're safe investment vehicles at this point?
Well, I think it's important to remember that ETFs are funds following the mutual fund regulations wherever they're domiciled. So you can have a bubble in an asset class, and ETFs might be providing exposure to that asset class, but they would be one of a number of ways to get exposure to the asset class. So ETFs themselves are not a bubble. I mean, to put it in perspective, although we talked about the ETF industry in the US being very close to $1 trillion, it took the mutual fund industry in the US 66 years to get to $1 trillion. But today, the mutual fund industry is 11 trillion in the US, and the ETF industry is 1. So in terms of proportion, ETFs sound very big, but relative to other products, they're still quite small.
So what makes ETFs so attractive at this point in time? Is it really because of the cost that is involved? And we know that during the financial crisis, we know a lot of asset managers really bore the brunt of the advent of ETFs, and a lot of people flowing to the ETF market. Is that one of the biggest reasons, or are there other underlying factors at this point?
Well, I think it's a couple things. One, it's going to be the fact that right now I think it's hard to pick individual stocks and bonds if you want to be able to invest all over the world. So people's investment horizon has gotten a lot bigger. So people think about developed markets, emerging frontier, they think about equities, fixed income, commodities, and it's rare for even an institution to have a team that's big enough to be able to think that they can pick individual investments and add alpha everywhere. So what you find is many people embrace ETFs where they don't feel they have the skill or expertise to deliver alpha themselves. The other is, if you look at using active funds, it's hard to find active funds that consistently deliver alpha in all market segments. And then as correlations have gone up, what you're finding is investors are finding it hard to pick individual stocks and bonds that are going to do better than the average. So what you're finding is, as news has changed this year, a lot of things happened that were unexpected. Middle East, North Africa, Japan, droughts and floods. People have wanted products that are simple, transparent, cost efficient, that they can buy anytime during the trading day with multiple brokers. And the fact that it's a fund structure means that you don't have to worry about having another Lehman type event where today, 3 years on, investors are still waiting to find out, will I get money back from my certificate swaps or structured products?
So we're almost seeing, I mean, it's a strong word, but a revolution happening, and that revolution driven by investor knowledge to a fair degree. 20 years ago, you knew you had to be in the market. You went along, there was a mutual fund, we call them unit trusts here. There was a short list to pick from, and I recognize that name, look what they've done. As the investors, I suppose, got burnt, emerging market crisis, 9/11, 2008, getting smarter, demanding better transparency, better diversification, saying alpha's nice, but you know what, beta's more guaranteed, and beta ain't bad either. And really just pushing it from that sense, industry responding to that demand and that upsmarting of the investor.
I think that's exactly right, and I would take it a step further. You know, if you get your asset allocation right with low-cost beta building blocks, you can deliver alpha. So we go back to the old Brinson Biebauer study out of the University of Chicago, that about 90% of the variation returns come from getting your asset allocation right. So we are seeing that investors are using ETFs as building blocks with the goal of generating alpha. And so whether that's through tactical asset allocation funds, sector rotation, building model portfolios, we're even seeing that people are creating target date strategies. So if you want to have a client who wants to invest for their children's university or to retire, you can buy products that use ETFs with the goal of maturing in 2015 or 2020 or some other point in the future. So I think ETFs have moved beyond just being low-cost beta and easy to tools that are being embraced really globally by everything from sovereign wealth funds to retail investors. And I think the unique proposition is that usually retail investors have a smaller toolbox and pay a lot more money. ETFs are the only product where whether you buy one share or invest 100 million, the annual cost is the same.
With regards to the manufacturing of these ETFs, how does one then decide with regards to weightings and which stocks are going to be included? What formula do you use?
Well, that's a very good question. So really, when you think about ETFs, the goal is primarily to track indices. So most ETFs are tracking index. So when you're managing a fund, you would look at the index and design a portfolio that's going to either fully replicate, or in some cases you might optimize. And when you optimize, it's because typically in emerging markets there might be stocks that have hit their foreign investor limits or aren't very liquid. And so you would look at a multi-factor model to design an exposure basket that will track but not fully replicate. So really what they're doing is following the guidelines from the index manager. So whether it's MSCI or S&P or some other index provider who says, here's the list of stocks, here's the weights, they will make sure that the fund is tracking the index, rebalances when they're told, and they will do the dividends and corporate actions in alignment with what the index manager is telling them to do.
With regards to the, if I could just interject there, with regards to the gold ETFs, again, I allude to some of the market rhetoric that we've seen over the past while, and I allude to specifically some of the verbiage coming through from GFMS. A lot of concern that if we do see a lot of money taken off the table when it comes to the SPDR Gold Trust Fund, we know that that is definitely under the spotlight, then it's going to create havoc within the gold market. Can we comfortably say that ETFs do start affecting the underlying price and not the underlying price only affecting the movement of the ETF?
Well, I think it's important to remember that most of the use of ETFs is done through secondary trading. So if people are buying or selling an ETF, it shares in that product and it's not going to the underlying market and buying more gold or selling gold. So most of the trading is secondary. And in the US, as you mentioned a product there, ETFs every day are about 26% of all equity trades every day. So they trade a lot on a secondary basis. In terms of net new creations this year globally, we've seen $68.2 billion of net new money go into ETFs. So if there are redemptions, people can go to the underlying and they would redeem for gold bars. But most people, when they say they want out of an ETF, they want cash. They're not interested in taking, exactly. So most people, although they say redeem, really what they want is, I want cash. I don't want to be in that exposure any longer. So please sell, give me cash, not that I want to take gold bars.
But isn't part of the issue, and particularly we come back to that gold one again, just simply because of its size. I mean, in South Africa as well, our biggest is gold, although pales in significance, a little over $2 billion, in the sense that if there were a slide in the gold price and individuals started to sell aggressively, the fund managers would then start redeeming and then have excess gold. And that's in part, I suppose, because of the huge popularity. Certainly I know some of the move in the gold price and platinum has been attributed to ETF demand.
Well, I do think that ETF demand, especially in the commodity market, is a small part of it. I mean, many central banks hold a lot of gold. Commodities are used a lot, and so you do see that real demand, supply and demand is affecting things. I think when you think about ETFs, it's important to remember when you want to buy or sell, you're not going to the manager, you're going to brokers. So if brokers have a large order where someone wants to sell, they're usually happy to keep inventory in their book because they know that very soon someone will probably come along and want to buy. So that's the reason that we don't see large creations and redemptions, unlike normal mutual funds. Because a normal mutual fund, when I want to buy as an investor, I go to you and say, here's cash, you buy shares. And when I want to sell and get out, you have to sell securities and give me cash. ETFs work in a different fashion where the secondary shares of the ETFs are trading as opposed to buying and selling the underlying securities or physical commodities.
Well, Debbie, from what you're saying, it sounds like a completely safe bet and completely risk-free.
Well,
what are there risks? Yes, exactly. Nothing is. But I mean, just hearing this, I mean, you know, you can sell out comfortably without worrying too much. It's not going to affect the underlying price if you sell out extensively. What is the risk?
Well, I think it's like anything. So if you're investing in emerging markets, you will have the economic and political risk of investing in those markets. So I think the structure of things that are ETFs are highly regulated because they're following, in Europe, the UCITS fund guidelines. In the US, they're following the 1940 Act guidelines. So these are guidelines to make products for retail investors and institutional. So I think the regulations are very specific. They want to be diversified. And so what can be held to what level is highly regulated within that structure. You have to look at what you're buying, though, because we're talking about gold. One of the challenges you find is making sure you understand what's inside of it. So sometimes it'll be gold mining stocks. Some of the products buy physical gold, some will buy front-month futures, and some will buy forward-month futures. And so the performance that you receive will be very different. So clearly mining stocks don't have the same necessarily performance that you might see in physical gold or in futures, because futures can be in backwardation or contango, which means the performance can be very different than what you would see in spot pricing.
So you need to understand the mix of the ETF that you're buying in.
Exactly.
As opposed to worrying
As always,
about other
understand what you're buying.
Absolutely.
Yes.